It's time now for the Muni Moment, and with the focus on the 2's10 spread, we take a look at how that's impacting the municipals curve. Taylor Riggs has more.
Yes, Bonnie, all eyes, of course, are on bonds. We'll fold that into the world of R.J. Gallo, who's head of the municipal bond group at Federated Investors. R.J., thanks for having me. So we have to talk about this. You have an inversion on the Treasury curve. What does that mean for the Muni 2's10s?
Well, interestingly, right now you have an inversion in the Muni curve. If you look at the SIFMA weekly financing rate, which is an index derived from variable rate demand notes, it's sort of short-term financing rate in the Muni market, that's around a little over 130, and the 10-year is pretty comparable to that. So you've got an inversion short of 10s relative to financing. 2's10s, however, not inverted, and has never inverted historically. Traditionally, the Muni curve is more upward sloping because of the greater time frame between short and long rates. That introduces more tax risk in the long run. So we don't tend to see Muni inversion.
RJ,
that said,
sorry,
the bull
continue.
market in bonds has undeniably affected all high-quality instruments. Munis are having an incredible year. The flows are really strong. The flattening of the curve means being neutral long duration, and owning fixed income has been a real win.
Well, sorry for cutting you off. I'm just excited, apparently, about getting to talk munis on TV. So, RJ, bear with me and stick with me here. Given the global bond rally that we are seeing, how do munis look relative to treasuries, rich or cheap in your book?
Well, all the ratios, Muni to Treasury ratios are generally rich to sort of longer-term averages. That said, I think that the rally in munis has partly been supported by the sharp change in the tax code. Even though banks and insurance companies don't like munis as much anymore because they have a much lower corporate tax rate, individual investors in states where the SALT cap is binding are still looking for municipal fixed income. I think also ratios have been driven fairly rich, in part because people are looking for positive yielding fixed income instruments in a challenging world. So traditional ratios suggest, yeah, maybe munis could fade some, but I'm not so sure that I would at this point in time. Instead, we're hoping that rates calm down. There's all this talk about negative yields in the United States. We don't think we're there until we get to another recession, and that's not our base case.
RJ, talk to me about that recession. I know it's not your base case, but if an inverted yield curve tells us anything, it could mean a recession in the next 12 to 18 months. How do munis typically perform in a recessionary environment?
Well, again, recession, not our base case, as you emphasized, and I want to emphasize that again. That said, in a recession, typically munis' high-quality instruments would start off with relatively favorable performance. But eventually, as Treasury yields keep going lower, munis would start to exhibit nominal underperformance just because of yield resistance from retail investors. I don't think retail investors are probably chasing negative yields in Europe, and I don't know if they would here. We know institutions certainly do because from a capital regulation standpoint, banks and insurance companies are still going to be buyers. A recession would be challenging to muni credit, ultimately. You have a number of states that don't have deep pockets. Most states have rebuilt their credit quality from the trough of the recession, undeniably. But if you see a recession in the U.S., you'll have some cracks in the Muni credit foundation, and that'll be a challenging time. That said, I think as a high-quality asset class, we would do fairly well, certainly in the early phases of any recessionary outcome.
So then quickly here, duration or credit?
At this point in time, we have increased duration in all the bond funds of Federated, taxable, tax-exempt. It's helped us to ride the wave to lower yields. We haven't been aggressively long, but we certainly toggled from strategically short for years to a more neutral position lately. At this point, I think you have to believe a U.S. recession is in the offing to get long at this level. If we get some tactical reset higher on the next announcement on U.S.-China, or if Hong Kong calms down, it's quite possible rates would reset a little higher and we'll enter into a range trade. But this is clearly a fast-moving and very vulnerable market, so at least neutral is where you need to be. On credit, we're leaning a little long in munis because we still see the flows coming into muni high-yield funds. Don't think spreads are going to tighten much, but the carry allows for incremental outperformance so long as we have no recession, which, again, is what we expect.